You're tuned to the Daily Fiscal Pulse for the 15th of July, 2026. Just a heads up, we're looking in the rearview mirror here, not watching a live feed. All of this data comes through Wednesday's close. Let's start by understanding what's captured the market's attention right now. Artificial intelligence and technology names are dominating the conversation. The narrative around Alphabet shares falling on reports that its most powerful AI model Gemini 3.5 Pro is facing delays is really shaping how investors are positioned. That backdrop is clearly influencing market moves. But here's what matters. We need to look past the headlines and see what the actual money is doing. Today turned out to be a substantial fiscal day. The numbers show net fiscal transfer hit $33.9 billion, driven primarily by household transfers that came in at $32.8 billion. That's real cash flowing into the system. Yet the market is holding its ground. ES futures settled at 7,617, maintaining a position above the 20-day moving average of 7,526. The 20-day trading band stretches roughly 267 points wide. So despite headwinds on the fiscal side, price is staying resilient. The longer view reveals what's actually happening underneath. Government spending over the past 5 days is averaging about $8.1 billion daily. Stack that against the 20-day average sitting near $15.2 billion, and you've got a meaningful deceleration. Less money flowing into the system translates to less velocity through households and into markets. Financial conditions are progressively tightening. Looking year on year doesn't change the picture much. Spending is running flat at $1,302.6 billion. There's no significant boost from fiscal support to work with. If you're holding longs, the fiscal environment deserves honest consideration. This backdrop isn't exactly tailwinds. Our conditions index is sitting at -78. That said, context matters. We've navigated setups like this multiple times over. Historical averages show the S&P still manages around plus 1.5% over the subsequent month. Even when liquidity thins out, markets don't track liquidity in straight lines. Positioning adds another layer. Leveraged funds continue adding long exposure while margin debt sits at the 100th percentile. That's historically more cautionary than constructive. Here's the practical reality. With fiscal flows tracking below year-ago levels, the shock absorber in the system is weaker. When headlines are positive, the market can still inch higher, but if a risk event materializes, like an escalation in the AI or tech space, downside moves accelerate because there's less liquidity to cushion the fall. We're also tracking 2 straight days of rising fiscal transfers. Our historical work shows that pattern has tended to lead to near-term ES strength. Nothing is guaranteed, but it's something we monitor. A few calendar markers worth noting. The 22nd of July brings the SSA payment cycle, the 4th Wednesday of the month, which can shift near-term flows around. The next significant Treasury coupon interest payment window lands around the 15th of August. Fiscal headwinds are unmistakably present in the data, but the rate of tightening may be leveling off. What happens next hinges on how these scheduled transfers actually execute. That's where the edge lies for positioning right now.